Hello, everyone. I'm really glad you're joining me this evening because I want to show you the trade signals that just came out within the last 30 minutes. And one of them you can trade literally right now. And the other one is for the New York market open. That's because the first one is a Forex trade and the second one is a stock trade. So let me just get right into it and show you what these are. The first is a recommendation to buy the Euro USD Forex pair. That's right. Buy the Euro at a price of 118.25 or lower and give it 130 pips tolerance before you stop loss, before it hits a stop loss. But if it gets up and takes 29 pips, take your profit. That trade is a pretty cool trade. I'm going to talk about it more deeply, more specifically here. And even a better way to do that might give you as much as a 90% chance of winning that trade. 90% chance. The second trade idea is for tomorrow. This is a stock. It's a small cap stock. It's Jack. Well, that's the ticker symbol, JACK, and this is Jack in the Box fast food restaurants. Now, you might like this place, you might not like this place, but the reality is they're beginning to open a number of new stores in new locations. And a restaurant chain, why does it do that? Because they've got a successful system and they know they can scale up. Right? So the stock price has kind of been going back between 14, 15, 16, 17, but it's possible that this thing is really ready to take off. Well, now that's an investing issue. That's investing. What I'm talking about is trading. You buy this stock at $16.70 or lower, and if it goes up 43 cents, you go ahead and take your profit, come back and do it again. Some similar kind of trade later, and you make lots of trades over time. And if you do it carefully, it's possible you could outperform the market. I did last year doing this same kind of stock setup. So I'm recommending it to you as a short-term trade, but I'm aware that, a lot of people are down on short-term trading. They're like, no, buy and hold. That's the best way. Hey, anything that makes you money over time, better than the market average, that's the best way. Because getting you to make money is not an easy thing. Sure, Warren Buffett says, yeah, well, I buy these stocks and I never sell them. But you're not Warren Buffett. You don't have all of the information that he has. And you can't go to some company and say, if I buy your stock, will you guarantee me a 5% dividend? Because that's the kind of thing he does, man. Normal, you and I, regular trader types, we can't call up Kraft Heinz and say, I'm going to buy 5% of your company, so I expect you to give me a better than market dividend. But he can, right? Anyway, so what I'm telling you is anybody could buy Jack at $16.70 or lower, sell it 43 cents higher, and if you do, you have an edge in the market. In this particular case, the edge is over 10%, right? So that's like if it were a coin flip, it was a 50-50 chance to win. This would give you a 60% chance to win, not 50. But it's even better than that because the trade setup is, risk 3 to make 1. So it starts at a 75% probability of win, but historically, the conditions that exist right now, we did some deep learning deep machine learning research on this, and we back tested for 20 years of data and forward tested for 20 years. That means out of sample. We say, okay, let's establish the rules, and then now let's try it for 2 years after the rules. All that 2 years data is not in the stuff that created the rules. That's why they call it out of sample. 2 years going forward, and the suggestion is that this setup, this particular set of rules that are lighting off the signal are going to give you a 10% statistical edge. So just the setup of the trade should make the probability of winning 75%. This is going to give you the probability of winning 85%. So that's a pretty interesting trade. All right, but that's for the market open. Now, as I was mentioning before, if you wanted to right now pull up your Euro USD chart on whatever platform you like to trade Forex, look at this setup right here. Now, I had mentioned before an entry price of 11825 or lower. Well, right now, the euro is trading well below that. And so if in fact it dips down, clear down to this area right here, and that's a trade amount of, it looks like 11782. So if you were to buy the euro at 1.1782 or lower, right where that green line is, and you give it a tolerance of 129 pips to the downside, but that if it goes up 29 pips, you take that. You take 29 pips. The probability that you're going to win that trade is over 90%. That's what our research shows. That if you just take this, right where it is, and it runs up, then you're probably going to, have at least a 75, maybe 80% chance of winning the trade. But if you wait for it to come clear down to 117, what was that number again? 11782, then you're probably going to have a 90% chance of winning. That's kind of a fun trade. Now, that trade is good for the next 24 hours. That price level, if the euro goes up and down, anytime it dips below that level and goes up 29 pips, you take your profit. Fun trade. How do we get these trades? Well, here's the Jack in the Box setup, right? Jack has come way down from above 20. It might goof around and it might get back up to 20, right? But all we're looking for is to just grab it under $16.70. And when it runs up 43 cents, just sell it. And that little move right there, high probability, 85% chance that it's going to do that. If it comes down here, it might go down a little bit, but it's going to come back up and at least get to there. Now, if you wanted to be an investor type, once it got there, you're like, okay, great, that's a head start. I'm just going to kind of move my stop up, let it go if it will. And who knows, maybe it makes it to 20 in the next few weeks. I don't have any way to predict that. What I do have is that there is a statistical edge to buying below 1670 and looking to play it back up above the 43% profit target line. All right, now I need to tell you about something that's going on right now. Yesterday, I started a series of presentations I call the Gamma Experiment. The Gamma Experiment is going to be something that gives you an edge in 0 days to expiration option trading. Okay, now follow me with this. You can look up these terms later, but I'm going to try to keep it real simple. Gamma is one of the option Greeks. It's one of the variables in an equation that determines option prices, and it's kind of the variable that governs the acceleration of the price. So yeah, you might buy it one day, but if the stock price goes up, it's a call option. That call option price has to go up, but by how much, right? Because there's nothing that says it has to go up exactly the same as the stock price. Option market makers, they come up with their own equations to try to figure out how much should we pay out, right? And they got to make sure they don't pay out too much, but they also can't pay out too little, because if the stock goes way up and their option doesn't move, then all of a sudden people could just exercise the option, buy the stock, make a big old profit. And they want to try to make it so that option price takes all that into account, because then they get more sales of the option and they are interested in making the transaction profit lots and lots of times. That's the market maker's game. So they have sophisticated equations with multiple variables in them. One of those variables is what they call gamma. There's another one called delta, and delta is like, if the option moves $1, if this underlying stock moves $1, how far will the option price move? That's going to be like, goes up $1 in the stock, goes up 50 cents in the option. That would be a delta of 50. Gamma says, how quickly will the delta change? Or what's the measure of it going up from $1 to $2, right? So the gamma, here's the way you can think of it. Whatever the gamma score is, the higher it is, the more rapid the change. Okay, that's the principle. Higher gamma, more rapid change. But there's another thing. The closer you get to expiration, the higher your gamma score is to begin with. And so if you look at options that are expiring on the last day and that are well, I'll get to that in a second. But if they're expiring on the very last day, then their gamma is super high compared to all other options. And if in fact it's also closer to the price, that's what they call at the money, right? Options are, if the option strike is further up the scale, is higher than the stock price, that's called out of the money. That's if it's a call option. And if it is lower than the stock price, that's called in the money. So you got in the money, at the money, out of the money, right? Okay, well, at the money, the stuff, the options that have a strike price that is right next to where the stock price is, those have the highest gamma of everything on the scale. Now then, think about it. Put all that together. Stuff that's going to expire today with an at the money strike creates an extreme opportunity because gamma really makes the option price accelerate rapidly. Okay, let me show you what I mean. I'll give you a little bit of a demonstration. Just about 8 days ago, I was tracking this on Google, and Google made this move. So this is a Wednesday. Okay, keep this in mind. This is what's changed in the markets. It used to be that everything expired on Friday and once a month. Then they established weekly options, and the more frequently your stock was traded, the higher volume, more demand there was for it, then the more they would make options that expired every single week. Well, now for the 7 most heavily option traded stocks, actually 8 if one of them counts twice. I'll explain that in a minute. But these 8 stocks, they're not just the indexes, the S&P 500 or the NASDAQ 100 or the Russell 2000. Those, each of them have an ETF that trades with options that expire every single day. Well, just about 3 weeks ago, they established options that expire every other day, Monday, Wednesday, Friday, for these 8 stocks, Google being one of them. These are, technically speaking, alphabet common C shares, right? Class C shares, whatever. The ticker symbol is GOOGL. And its options trade a little more liquidly than GOOG, which is the Class A shares. Yeah. Just go with me on this. Google, with the L, is this. It moved up and down hardly anywhere. And just from the bottom to the top of the day's trading was only 1% change in price, from about 301 to about 305. And so about $3.50, right? Just a little over 1% move. The very end of the day, look at those candles going up. It's going from its low, not quite to its high. It goes from 301.50 to 303.50, a $2 move, right? 2/3 of 1%. That's what Google did in the last half hour of the day. Now, let's compare that to how the option price moved. If you looked at a option that was, right there at the 305 strike price, right? It's the first one out of the money, and it expired about 45, 50 days out from that time. You would see that this thing, no, it wasn't 50 days. It was more like March 20th. Yeah, that'd be about 32 days out, right? Okay, so anyway, you'll see it went from a low of 950 up to about 1050. So Google makes a 0.2% move, but the option makes a 10% move. It's $1 starting at $9.50 and it goes to $10.50. That's a $1 move during that same half hour. So you see the leverage that's happening. Google's up a little, that option goes up a lot, right? Except that's not even the big news. Check this out. On this next slide, we can see, although the 10% change happened with an option that was out for just over a month, the stuff that expired that day on February 18th, when Google went up by just $1, this option went from 5 cents to over $1. That big green bar went all the way up to like $1.30. So there was a 1,200% change in that price during that time. Now, I didn't catch 1,200% gain, but I was trading this stock and I managed to double the amount I was risking. I bought options and risked about $600, and I made $1,200 on that demonstration trade that I was doing. So here's the look of it. See, I bought them at 60 cents. They went all the way down here. I bought them again at 7 cents, not the 5, not the low, but the bid ask was 5 by 7, right? So I got 7 and up it went. When it was all said and done, I sold everything at 63 cents. So if I go from, start with some of it at 60 and then some of it 7, turned out my average price was about 27 cents. And I sold it at 63. Not quite triple, but a good bit more than double. So it was an amazing trade. Now I could have held on, in theory, the end of the day, prices were much better, 83 cents or 90 cents, but you got to do what you, in the moment. It's hard to know precisely how things are going to go. And I didn't want to have it just come way back on me in the last minute. So I just went ahead and took this trade, and it was fabulous. This is the kind of thing, though, that can happen all the time. It doesn't happen every day, but any given day could happen. Today turned out to be a very amazing moment, and I'll show you how that turned out. But I am trading this stuff live, free trading environment where you can watch what I'm doing. Wednesdays, 2 p.m. Eastern time. I am trading, I call it the gamma experiment. I'm trading these same kind of trades that I'm just describing to you. Now, I like to think of this as a way to beat the casino. All right? It's because long ago, I had people ask me a lot, what's the difference between gambling and trading? And I thought about it over the years, and I realized, there's a lot you could say about, well, stocks and research and work and blah, whatever, fixed rules. Here's the bottom line. The difference between a casino and the market pays better odds. Yes, it does. And the thing is, casinos, they run games that they believe give them a statistical edge. So it doesn't matter what you do, just as long as you keep playing enough, they will eventually win your money. Well, most of the time. Unless, of course, you're a real sharp shooter that understands the probabilities better than the house, better than the casino. There's a famous story featured in Atlantic magazine and a bunch of other places, and you can actually find the story if you just go onto YouTube and search Don Johnson Casino. Okay, Don Johnson, no, I'm not talking about the Miami Vice actor. I'm talking about the guy who walked in and took 3 different casinos over the course of about 3 months for $5 million each. He now has a lifetime ban at Atlantic City. No, thank you. You can't come here and play anymore. Those casino chains, worldwide ban, won't let him come and play at their casinos because he rocked the house. But the story of how he did it is really interesting. So if you search for it, you get stuff like this. The man who tricked casinos into letting him win. The man who legally stole $15 million. He's like, no. He didn't steal anything. And he didn't actually trick them either. He just walked in and he did his math better than they did. And the story is really great. He tells how, well, there was this period of time where casinos were really struggling. And they figured, hey, we need to have profits right now. And, this was back in like 2008, 2009. And they were trying to stay afloat, And so they figured, let's get our whales, our big rollers, to come in and we'll give them a deal. We'll say stuff like loss rebates. We can give you a 10% loss rebate. So if you lose $1 million, it's okay. We'll give you $100,000 back the next night if you want to come back and try again. It's just a way to keep you playing. They figure as long as they've got a small edge, they'll still win it. They figured, okay, people who walk in off the street, we're in charge this much edge, basically. That's where their games are set. But we'll sit down with these whales and say, all right, let's negotiate. We'll give you that much. We'll take even a smaller edge. So you got a better chance of winning. Come on and play with your hundreds of thousands or millions of dollars, because we know that eventually you're just going to lose it, and we need the money now. So come on, big rollers, come lose a lot of money with us. That's what the casinos thought they were doing. Don Johnson, however, he wasn't just some random guy. He was somebody who studied. He studied gambling at all sorts of levels, in all sorts of sports or gambling ventures. And so he was kind of an industry insider. He knew how everything worked. And when he heard that the Atlantic City casinos were desperate, he thought, maybe I could get them to give me a collection of concessions, and they'll think they have the edge, but mathematically, I'll have the edge. The question is, can I get one over on them like this? And so he goes in person, sits down and says, hey, thanks for calling me in. You're talking about giving me a 20% loss rebate. That's amazing. But can you give me a few other things? They're like, well, what do you have in mind? Well, okay, I got a few rule changes. When I'm playing, I know how your dealers, I know what your rules are, what your dealers follow as rules. But at the high stakes table where I'm going to sit down, I would like for you to put it in writing that dealer, you'll tell him, these are the rules. I want you to stand on a soft 17. Don't hit it, right? Well, they have this calculator. I'm like, oh yeah. Well, let's see how that would change the edge. It brings it down, but he still has, but the house still has the edge. And they're like, okay. And then he talks about a few other things that he knows they don't have the math on at hand. They don't even know how to type it in and judge what the impact of that on the game is. They'll sit there and think about it like, that doesn't sound like much. Sure, we'll give it to him. But little by little, it's just, another straw on the camel's back, so to speak. And pretty soon, Don gets them to a place where he knows he has the mathematical edge. No cheating needed. Now he is better off than the house. He just has to play carefully, consistently, and not quit. And eventually the money will come his way. So they give it to him. They set it in writing, and he knows as soon as I win big, they'll never let me play again. So I got to make this worth my while. That's why he made it with 3 different casinos, set it all up. And over the course of 3 months, he won $15 million just playing blackjack according to the rules that he had set down. It's kind of a fun story, isn't it? Don't you think? It's like, wouldn't you like to be this guy? Challenge yourself to be consistent and disciplined, because not everybody do it. I know I couldn't do it. Even if I had the ability to write those rules down and get them to sign it, I don't know if I'd have the ability to be disciplined and say, I'm only going to bet this certain amount every single time. If my balance changes, I might change my bet size, but I got rules for that. I got to know what they are. He went in there and played for hours and hours, and then he'd walk out. Some days he was down $500,000, but he knew, if I come back tomorrow, I'll be able to just keep going. And they're giving me loss rebates. So if I'm down $500,000, they're going to give me $100,000 to start with the next day. So he had to be careful. He played a consistent game, perfect basic strategy he played. And yeah, all of a sudden one day he starts cranking it up, and they're like, don't you want to take a break? Don't you want to go to dinner? Come on. He's like, nope, I'm having fun. Let's keep going. So he hits this certain level, and finally they're like, "You're not welcome here anymore." And so, I mean, they had written rules that they couldn't kick him out up until a certain point. But once that ran out, he walked away. 15 million. I mean, that's life money, right? I don't have to care anymore as long as I don't blow it on the next hand of blackjack. Anyway, the idea here is this. What if I had the ability to figure out when I have an edge? What if I could say at a certain price, I have the ability to make a bet. It doesn't win every time, but I have a greater than random chance of winning. And the amount I'm going to win is larger than just a break-even play, so that the edge is now in my favor. Could I create a thing like that? Now, you look at this chart of Apple, right? The option price goes up and down, and this is a put option. So when Apple's going down in price, the option price is going up. That's why you see red candles on the top. That's Apple's price dropping from 264 down to 262. It's just a $2 move. It's just a 1% move. But look what the option price does. This is it going from $1 or so, about $1.10, all the way up to $3.50. Now, if I buy $1.10 and I'm wrong, it just goes to zero. Apple doesn't go down. Apple keeps going up. My option price just goes to zero and expires that same day. Oh well, I lose whatever I put in. But if Apple drops just $2, this option more than doubles in price. It doesn't go from $1 to $2. It goes from $1 to $3.50. That's big. That's so big that if I win only 33% of the time, I would still come out ahead. I would still have an edge over the casino, the market, that is. So this $2.75 move created a 160% move on this Apple option. Now, this Apple option expired on February 20. Is that right? Yeah. But now, if you consider the same thing, if I go, sorry, this option is like the 265. So this is one in the money. I was talking about in and at and out the money. This one's in the money, right? But look at if I go just out of the money. Now I buy this thing at 33 cents. Same move, but instead of 160%, it goes to 280% price change. This is what I'm talking about. This is just a 1% move. It's a good move. But when it goes good and when I get it right, I need to make a big windfall to be able to make sure that I can pay for whatever losses I'm going to have. In this case, 280%, almost quadruple the price. 33 to 125. It's like, if I can win that big of a gain on these, then I don't have to be right every time. This can pay for a lot of losers. I can do 33 cents. I mean, a 33-cent contract, that you can make that trade for only $33 plus commission. So even if you only have something like a, $3,000 or $4,000 account, you would only be risking 1%. And this trade goes from $33 up to $125 in value just in about an hour's time, not even an hour's time. So this is the kind of thing that these option setups are giving you. I'm thinking that if I can find a way to use Edgefinder's deep machine learning research entries and targets to where I could say, buy this thing here, and if it goes down, you lose it, zero. But if it goes up, the target that it will go to will likely double the value of the option, maybe more. And that's the kind of thing that I don't have to be right all the time with. But in fact, if I can even be right 50% of the time, I could do really well. And I've been keeping track of these trades to try to give you an idea of what the opportunities are. I should show you just what happened today on IWM. An amazing trade. I was so shocked that it worked out this way. I'm going to show you my screen here. And Edgefinder, you see, gave me a target. And this target area is what I call the dead zone. And by dead zone, I mean, I don't want to initiate any trades inside there. But below it, I want to be a buyer. And above it, I want to be a seller. Now I need some help to figure out what price is optimal for buying it, right? How do I make a Don Johnson, the price, the edge is in my favor kind of setup, right? I use this line right here. This is a Keltner channel with some particular settings. I'm going to reveal what those settings are on Wednesday in my second Gamma experiment trade setup. But just for now, I use these to give me a level where I say, okay, I'm going to project that forward. And from that level, I'm going to be ready to buy. So that's what happened on IWM. When IWM dropped down here, that was the level. That occurred at 12:40 Eastern time. And the price of the 263 call, see, the price was 262.81. So the first one that was, out of the money, that was the first, it's like the at the money because it's closest to the stock price. That one was 263. So I took the 263 call at 12:40. It was 60 cents per share. So one contract equals $60. 10 contracts would be $600. 100 contracts would be $6,000. Past 100 contracts, you're really getting, you're starting to get a little risky because you might not have a seller that wants to sell more than 100 contracts on, all at once. On IWM, SPY, and QQQ, it's quite possible to get 100 contracts filled. It is. But you just sort of risk it if one of those people doesn't happen to be around. The big roller table is full. So I would say that there's a functional limit up to about 100 contracts. Anything below 100 contracts, no problem. For those three ETFs, you are going to get filled. So anyway, you can get an idea of how you can go for as little as $60, but for as much as $6,000 that you would risk. And then see what you can get back from that. Well, you get in on this trade here at $60 per contract. It goes down. This low is actually about 30 cents down here just for an instant. This thing has lost half its value. So you got to be prepared for that. Just like Don Johnson, he's down a bit, but you're like, okay, I can keep going. And you keep going, and it doesn't always work. Sometimes it goes to zero, and you got to have, enough capital to trade another day. That's why you don't risk more than 1% of your account. But if you put your whole account into this trade and it goes to zero, sorry, you do not get another chance. You do not get loss rebates. You don't get to come back tomorrow and try again, right? Put in 1%, you'll rarely ever have a situation where you lose so much money you can't come back and try again tomorrow. If in fact you have a 263 call, you get in at 60, you watch this go down to 30 cents, but you say, it doesn't matter. It doesn't matter if I lose the whole thing. Let's just see how it plays out. By 13:10 Eastern time, 13:15, that thing's back up above break even and it's starting to make you money. And by the time you get up to here, that is the level where your profit target, that $1.17 target, gets hit, which is right about that level, not even before you make it to the dead zone. So if you were to take your profit right then out that target, 13.40, the price happened to be $1.20. Yes, that's right. Doubled your money in an hour right there. See how cool Gamma is when you have the advantage in your favor? Oh, but it gets better. On this day, IWM, this is earlier today, it kept going up. It went all the way through the dead zone because that's what Edgefinder said was more likely than random to happen. If you start at the bottom of the dead zone, you're more likely to go all the way to the top. Doesn't always happen, but there's an edge there. And so isn't this great? The idea you could get $1.17 starting clear back here and then still get it if it goes up and all the way through. If you had held on by the time, maybe you wouldn't know that you were going to get out, that it was going to run all the way up and up. Maybe this got you freaked out. Maybe you even just said right here, I want out. Well, right here, the 263 call was at about 250. But if you could hold on through that and sell somewhere either here or even right at the end of the day, you get $3. Start with 60 cents and go to $3. Do you see what I'm talking about there? That's a 5 times increase. 5 times. Yeah. Now, this is not incredibly, rare that this happens. It doesn't happen every day, but it happens at least once every other week, maybe every week for some of these trades. Of the trade signals I've been getting, I have seen a trade like this occur at least once every week. And I've seen lots of other ones that are not quite as good, but they're still winners. So the gamma experiment is like, if you're careful, I think you have an edge. You got to wait till the last half of the day when gamma scores are high and getting higher, because they get higher all the way to the end of the day. You got to trade with at the money options to start. And you got to have some deep machine learning research to tell you where's a place where the odds are in your favor. You have all three of those things together, kapow. You could have a system that is Don Johnson gambling like, but with markets that pay better odds than a casino. I mean, okay, I know. I'm trying to get you excited, and you should be. I am excited about it. I am trading real money. On Wednesdays, the stuff I'm doing, I'm not a licensed financial advisor. Well, close to it, but I'm not doing this in that capacity. This isn't this isn't investing or trading advice. It's educational demonstrations. So when I'm doing it on Wednesday, what I'm showing you is I'm putting it in paper trade. But once that's done, I'm running over to my live money account and I'm putting these trades in for real. Now, they're going to be different from what I showed because, they're going to have to happen a few minutes later. So, well, it turned out on Wednesday that I put on several possibilities, ideas as trades, and I went and put in the actual trades, and I actually made money. It wasn't much. It was only 1/3% for my whole account. But thing is, Wednesday was a really crummy day. It was one of those days where you say, well, it didn't work today. It doesn't always work. I'll come back and try again the next day, right? And then Thursday, today, was just an amazing day. So little by little, you can be careful. I am pretty excited to trade this. I'm pretty excited to share it with anybody who wants to show up and watch, because I want you to figure out, hey, can I make it work too? Is it just Gordon getting lucky? Or is there really a gamma edge for the retail trader in the markets right now when they've just opened the floodgates on Mag 7 stocks, having zero DTE options, not just on Fridays, but 3 different days of the week? I think for a little while, there is going to be an edge if you know how to exploit it. So join me on Wednesday. Next Wednesday, I'll give you an update on how my trades have been going through the week and review the rules, tell you a little bit more about the Edgefinder system that gives me these excellent opening points, the dead zone and the target. And then I'll tell you about these Keltner channel lines and the settings I use to help me say what is an optimal reversal point that I can rely on. Until next time, everyone, I hope you'll join me, and take care and trade well.